Hi, my name is John Cork. I'm 18 years old and I go to Utah Valley University. I'm a business management major and today I'm going to be presenting about options trading. So what are options? Options are derivatives of shares of an asset. For each option an investor owns, he controls 100 shares of asset. Options are a contractual agreement between two parties, a buyer and a seller. Options are extremely volatile and change value at a much higher rate than other investment tools. There's two main kinds of options, call options and put options. So right here you can see an option contract example. This lady on the left is offering her right to the 500 shares that she owns to the buyer for a premium or a price, and this buyer therefore has the right to buy those 500 shares at a specified strike price that they have agreed upon. So option buyers and sellers explained. So investors can participate in either side of the options process by buying or selling calls and puts. The buyer of the contract has the right to buy the underlying asset at the agreed upon price, and the seller of the contract is contractually obligated to sell the underlying asset if the buyer exercises his rights. Statistically, it is more profitable to be an options seller in the long run than an options buyer. So right here you can see an example of the popular investing platform Robinhood. And there's a lot of things you can take away from here, but the main things that I wanted to show you are the amount of contracts the investors own. You can also see the expiration date on the contracts, and you can also see the current price of the contracts and the average cost that they paid for it. So how can investors create any assumption with options? Options allow investors to have complete control over their investing assumptions. While when investors are just trading stocks, they have two options: to long the stock or to short the stock. Options give investors whatever assumption they possibly could about the underlying and capitalize equally on their assumptions. There are four main assumptions with options: the long call, the short call, the long put, and the short put. While each assumption sounds similar, they all give very different results and pros and cons to each other, and the investor must decide which one is best for his situation. So call options. Call options give the buyer the right to buy the underlying asset at a specific price. Buying call options is considered a very bullish strategy. Call options are bought by investors when they think there will be a significant increase in the price of the underlying during the life of the contract. Call options can also be sold by investors to create a bearish stance on the underlying if they think the price of the underlying will not go up. Put options. So put options give the owner of the contract the right to sell the underlying at a specific strike price. Put options are bought by investors when they assume the price of the underlying will continue to decrease. Put options would be considered a very bearish strategy. They're often used to hedge large asset positions during market pullbacks. For example, if you were holding 10,000 shares of Apple and you wanted to hold it through a 5% market pullback, you can use put options to help negate the risk of that on your portfolio. So what are the four main option assumptions? The most popular assumption is buying calls or long calls, which would be considered a very bullish assumption. The second most popular assumption would be longing puts or buying puts. This would be considered a very bearish assumption. The third most popular assumption would be shorting puts or selling puts. This means the investor is selling contracts assuming that the price of the underlying will continue to increase. The fourth and least popular assumption would be selling calls. This means that the investor thinks that the underlying will continue to decrease. So you might be wondering, how do options derive their value? Options derive their value based on something called the theoretical options pricing model. Their value is then expressed by something we call the option Greeks. There's four main option Greeks that really are important to understanding options trading. Those four option Greeks would be delta, theta, gamma, and vega. Other than these four option Greeks that help you understand an option's value, Options derive their value on many different things. This includes their current stock price, their intrinsic value, their time to expiration, and implied volatility of the asset and current market. So the first option Greek I want to tell you about is delta. Delta measures the option's sensitivity to directional moves in the underlying asset. It can happen in either direction, and it ranges from +1 to -1. When the price of an asset changes, so does the value of the contract's delta. So right here you can see what I'm talking about. The closer that the option gets to becoming in the money, the higher the delta of the contract becomes. This is a very important relationship to understand why options move at such an exponential rate. The next option Greek I want to talk about is gamma. Gamma is the rate at which the delta moves. The rate of gamma in an option constantly changes when the price of the asset changes. A contract's gamma is usually at its peak value when the asset's price is quickly approaching the agreed upon strike price. Gamma is the acceleration of an option's value, while delta is the speed at which it moves directionally with changes in asset price. Right here you can see how gamma differs with different expiration dates on the contract. With 9-month contracts, you don't see as much percentage change in gamma, while with the 3-month contract, you'll see large differences in the price of the gamma. This will directly correlate to changes in the price of the option. The next option Greek I want to talk about is theta. Theta is the time decay element of the option. All options suffer from time decay over the life of the contract. Theta is what we use to measure this time decay. Theta will accelerate more quickly the closer the option gets to its expiration date. And theta could be considered an advantage to option sellers as it slowly chips down at the option's price. So right here you can see what I'm talking about. At 9 months, you don't see as much movement in the option's value. It's not decreasing as fastly. But in the last 2 to 3 months of the option's value, theta really does take control and quickly erode the option's value. The next option Greek I want to talk about is vega. Vega measures an option's price relative to change in volatility. Vega is based on changes in the volatility of the option, the stock, or market as a whole. Vega helps traders understand how much options are expected to move directionally. Vega is very important when investors are trading underlyings that are extremely volatile, such as Tesla or Nvidia. Vega will help investors understand maybe when they are paying too much for a option contract or if it's slightly overpriced. Right here you can see an example of Vega. So with the 3-month contract, there's not as much long-term volatility with the underlying, but with the 9-month contract, you can see large changes in the Vega because there's still a lot of unknown about the long term for the company or underlying that you're trading. So intrinsic value. What is intrinsic value? Intrinsic value is the value of the option contract if it expired today. The way that intrinsic value is calculated is by subtracting the current stock price by the agreed upon stock price. So if Apple was trading at $250 today and you own the $240 call option, your option would have $10 of intrinsic value. So extrinsic value. Extrinsic value goes hand in hand with intrinsic value. Extrinsic value is calculated by subtracting the intrinsic value by the current option price. Extrinsic value is known as the risk premium of the option. Two of the most important factors when looking at extrinsic value are the time premium and implied volatility of the option. The closer the option gets to its expiration date, the faster the extrinsic value of the option will decay. Implied volatility. So implied volatility is a metric 0 to 100% that is used to understand the market's view on whether an underlying will have a significant move directionally. Implied volatility is calculated into the price of the option when the option buyer buys it. This helps negate some risk for the option seller on volatile underlyings such as Tesla or Nvidia. Right here you can see on Robinhood again, you can see the implied volatility of the option contract. You can also see, again, the delta, theta, gamma, and vega, the four main option Greeks that help you understand option price. Here's another example of an options chain. This is on Thinkorswim or TD Ameritrade. Right here in the middle, you can see the strike prices, and then delta, gamma, vega, implied volatility, open interest. You can take a lot of information and data away from these very quickly and learn a lot about an underlying simply by looking at the options chain and what options are trading for. So hedging. What is hedging? Hedging is a relatively cheap way that allows investors to hedge long positions in a portfolio. Hedging protects the investor's long portfolio positions by neutralizing the overall risk in case of a market downturn. Another really popular name for hedging would be considered buying protection on positions. Hedging allows investors to hold positions for longer amounts of time and accrue more wealth from those positions without holding the same amount of risk. So you might be asking, what is the main difference between buying options and buying stock? So while similar, stock and options really do not have that much in common. When you buy stock, you're buying partial ownership in a company. But when you're buying an option, you're buying just a contractual agreement with somebody else for the underlying. While option contracts can expire completely worthless if it does not hit the strike price, company stock has no time value and can be held for however long the investor sees fit. Stocks also give the advantage to investors to participate in things like stock splits or dividends, which can help investors accrue more wealth. Right here, you can see an example of the S&P 500 index, which is the 500 biggest companies in the United States, and the put right index, which writes put contracts to sell to investors who trade the S&P 500. So you can see over time, since 1986, it has always almost been more profitable to sell insurance to people who are trading the S&P 500 than just trading the S&P 500. This is extremely important and one of the main things that shows why options can really be superior to trading stock. So open interest. What is open interest? Open interest are the amount of contracts that are currently being held by contract buyers. Open interest is used by investors to help them understand what is the most popular and sought after stock or sought after options on the market. Many investors will use open interest to help them determine what options to buy and sell. Understanding open interest is extremely crucial to having long-term success trading options day in and day out. Right here you can see an example of an open interest sheet, and on the left we see the ticker symbols for the companies, the strike prices for the options, and then whether they are call or puts. And over here we can see the change in open interest of the amount of contracts. So up here there's 58,000 new contracts that have been bought. This put option has 58,000 new puts. So this is a very sought after contract. Here's a picture of the New York investing floor. This is where a lot of options trading historically has come from and became famous. Here's a quick video just to give you an idea.
If money is evil, then...
I think that video gives you a pretty good explanation of how crazy options trading and asset trading can be on an institutional level. I think it's really important to remember all this stuff really does have real world implications. So what are my points that I want to summarize to you for you to remember? So options are a unique outlet available to investors to allow them to negate risk differently. Options allows investors to manage risk on other assets they maybe already own. And options are just derivatives of other assets. They are just a contractual agreement. They are not worth anything by themselves. Another thing to remember is options have immense volatility. They can make a lot of money or lose a lot of money very quickly, and understanding that is very important before trading them. Option prices are highly affected by day-to-day price movement. I think it's really important to remember that every single day option prices are drastically changing, whether it be even a $1 move in the asset price. I hope you really liked my presentation. If you have any questions, please let me know. Thank you again.